Most traders believe they're losing money because they don't know enough. That's the story they tell themselves. More indicators, more strategies, more signals. But what if the real reason has nothing to do with knowledge at all? What if the thing quietly draining your account isn't what you know, but how much you're willing to lose? Let me ask you something. Have you ever been right about a trade, but still lost money? Or worse, been wrong, but stayed in the trade anyway, hoping it would come back? That's where this begins. You see, markets don't punish ignorance as much as they punish inconsistency. A trader can be wrong often and still make money. But a trader who loses control of risk, even occasionally, eventually gives everything back. And that's where the 2% rule enters. Not as a trick, not as a system, but as a line in the sand. Why 2%? Why not 5% or 10% or just whatever feels right? Because the market doesn't care what feels right. The 2% rule is simple on the surface. Never risk more than 2% of your total capital on a single trade. But beneath that simplicity is something far more powerful. Something most traders don't recognize at first. It's not about protecting your account. It's about protecting your decision making. Think about this. What happens to your thinking when you risk too much? You hesitate on entries. You exit too early when you're right. You freeze when you're wrong. Every tick against you feels personal. Every fluctuation starts to matter more than it should. Now ask yourself, are you really trading the market at that point, or are you just reacting to fear? Because once emotion takes control, your strategy, no matter how good, becomes irrelevant. That's the cause. And the effect, inconsistency, forced decisions, chasing losses, breaking rules you promised yourself you'd follow. Now here's the part most people overlook. The 2% rule doesn't just limit loss, it creates stability. When you know that no single trade can significantly damage your account, something changes internally. You start thinking in sequences instead of outcomes. One trade doesn't define you anymore. Have you noticed how beginners obsess over individual trades? Was this a good trade? Did I win or lose? But professionals ask a different question. Did I follow my process? Why? Because they understand something crucial. Outcomes are random in the short term, but behavior compounds over time. And the 2% rule enforces that behavior. Let's go deeper. Imagine losing 10% of your account on one trade. It happens more often than people admit. Now you're not just trading, you're recovering. Your next decision is no longer neutral, it's influenced. You want it back. And that's where the real damage begins. Not in the loss itself, but in the urgency that follows it. Have you ever taken a trade you wouldn't normally take, just because you wanted to make back what you lost? That's not strategy. That's emotional debt, and emotional debt leads to more risk, not less. Now compare that to risking 2%. You lose a trade. It stings, but it doesn't shake you. You take the next setup with the same clarity, then the next, and the next. You're still operating within your framework. That's the difference. The 2% rule doesn't eliminate losses. It makes them survivable. And more importantly, it keeps your mind intact. But here's where it gets interesting. The rule only works if you actually follow it. And that's where most traders fail. Not because they don't understand it, but because they abandon it at the worst possible moment. Why do you think that is? Because discipline isn't tested when things are going well. It's tested when you're frustrated, when you've had a losing streak, when you feel like you're due for a win. That's when traders increase position size. That's when they override their own limits. And that's when the 2% rule stops being a rule and becomes a suggestion. Let me ask you, do you treat risk as a constant or as something flexible? Because the moment risk becomes flexible, your entire system becomes unstable. Consistency in trading doesn't come from predicting the market. It comes from controlling yourself. And the 2% rule is one of the few tools that directly enforces that control. Now let's talk application. This isn't just about saying, I'll risk 2%. It's about calculating it correctly. You don't risk 2% of your position. You risk 2% of your account based on your stop loss. That means position size changes depending on the setup. Wide stop, smaller position. Tight stop, larger position. Most traders do the opposite. They fix position size and ignore stop distance. That's how they accidentally risk 5%, 10%, sometimes more without realizing it. Have you checked your last few trades? Do you actually know how much you were risking, or did you just assume it was about right? There's another layer to this. The 2% rule forces patience. Because when you're risking less, you need quality setups, not just activity. You can't afford to take random trades and hope they work out. The math doesn't support it. So naturally, you become more selective. You wait. And waiting in trading is where most people struggle. Why is that? Because doing nothing feels like falling behind. It feels unproductive. But in reality, it's often the most profitable decision you can make. Now consider the long-term effect. If you risk 2% consistently, even a losing streak doesn't wipe you out. You stay in the game, and staying in the game is everything. Because trading isn't about one trade or 1 week or even 1 month. It's about survival long enough to let your edge play out. And without risk control, there is no survival. So the question becomes, are you trying to win trades, or are you trying to build a process that can withstand losses? Because those are two very different mindsets. One is short-term and reactive. The other is structured and sustainable. And the 2% rule sits right at the center of that difference. But here's the part most traders don't realize until much later. Once you truly commit to controlled risk, your focus shifts. You stop asking, how much can I make on this trade? And you start asking, is this trade worth the risk I'm about to take? That single shift changes everything. Because now, you're not chasing opportunity, you're evaluating it. And when you begin to evaluate instead of chase, your entire relationship with the market starts to change. You become quieter, more selective, less reactive, and slowly, almost without noticing, your results begin to reflect that shift. So ask yourself honestly, if every trade you took from this point forward was limited to 2% risk, how would your behavior change? Would you take fewer trades? Would you wait longer? Would you finally respect your stop losses instead of moving them? Because that's where the real transformation happens. Not in the rule itself, but in the behavior it forces. Small losses are not setbacks. They are the cost of staying in control. Most traders don't see it that way. They see a loss and immediately label it as failure. Something went wrong. Something needs to be fixed. But let me ask you, what if nothing went wrong at all? What if the loss you just took was simply the market doing what it always does, moving without obligation to your expectation? The problem isn't the loss. The problem is how you interpret it. When you treat every loss as a mistake, you start avoiding them. And the moment you try to avoid losses, your behavior changes. You hesitate to exit. You widen stops. You hold on longer than you should. You convince yourself the trade just needs little more time. Have you noticed how quickly a small, controlled loss can turn into something much larger, simply because you didn't want to accept it? That's where control begins to slip. A small loss, taken properly, is a decision executed with clarity. You defined your risk before entering. You accepted the outcome before the trade even began. And when the market proved you wrong, you acted, without negotiation. That's not failure. That's discipline in motion. But most traders don't operate this way. They enter trades focused on potential profit, not predefined risk. So when price moves against them, they're forced into a decision they never prepared for. And under pressure, decisions become emotional. Now ask yourself, are you reacting to the market, or are you reacting to the discomfort of losing? Because those are two very different things. A controlled loss carries no urgency. It doesn't demand recovery. It doesn't force your next move. It simply exists as part of the process. But an uncontrolled loss creates tension, and that tension doesn't stay isolated. It spills into the next trade, and the next. This is how inconsistency begins. You start adjusting your behavior, not based on your strategy, but based on your last result. A loss makes you cautious. A win makes you careless. And over time your system becomes unrecognizable because it's no longer being followed consistently. So the real question is this: are you trading your plan, or are you trading your emotions? Small losses, when accepted properly, remove that instability. They keep your behavior grounded. They prevent a single trade from influencing the next. And that's where control is maintained, not in winning, but in staying unaffected by losing. Think about it this way. If every loss you take is small and planned, then no single outcome has the power to disrupt you. You remain steady, you remain objective, and most importantly, you remain capable of executing the next trade exactly as intended. But if losses are avoided, delayed, or expanded, then each one carries weight. Each one leaves an imprint, and over time, those imprints shape your decisions more than your strategy does. Have you ever felt hesitant to take a valid setup just because the last trade didn't work? That hesitation doesn't come from the market. It comes from unresolved loss. This is why small losses are essential. They resolve quickly. They close the loop. There's no lingering doubt, no emotional residue. You take the loss, you move on, and your mind stays clear. Clarity is what allows consistency, and consistency is what allows any edge, no matter how simple, to actually play out over time. Without that, even the best strategy fails. So when you take a small loss, you're not stepping backward. You're reinforcing a standard. You're proving to yourself that your rules matter more than your impulses. And every time you do that, you strengthen the one thing most traders lack: the ability to stay in control when it matters most. The 2% rule doesn't protect your account first, it protects your mind. Most traders think in numbers. They see percentages, balances, profit targets. So when they hear, risk 2%, they assume it's about preserving capital. Keep losses small. Avoid blowing up. Stay in the game. That's true, but it's not the real reason the rule matters. Let me ask you something. Have you ever felt completely different emotionally between two trades, even when the setups were similar? One trade feels calm, controlled. The other feels tense, urgent, almost personal. What changed? Usually, it's not the market. It's the amount you put at risk. The human mind doesn't process risk logically. It reacts to exposure. The more you risk, the more your brain shifts from decision-making into defense mode. You stop thinking in probabilities and start thinking in outcomes. You don't want to lose, so you begin interfering. You cut winners short. You move stops. You second-guess entries. Every tick starts to matter more than it should. Now ask yourself, are you trading your strategy at that point, or are you trying to protect yourself from discomfort? Because once discomfort takes over, your decisions are no longer clean. This is where the 2% rule quietly changes everything. By limiting your risk to a small, predefined amount, you reduce the emotional weight of any single trade, and when the emotional weight is reduced, your mind stays functional. You can observe without reacting. You can execute without hesitation. It's not that fear disappears, it just stops controlling you. Think about the alternative. When you risk too much, even one trade can feel significant. And when something feels significant, you treat it differently. You watch it more closely. You interfere more often. You become attached to the outcome. Have you noticed how attachment grows with position size? That's not coincidence. That's psychology. The more you risk, the more your identity gets tied to the result. And once that happens, objectivity fades. You're no longer analyzing the market. You're defending your position. That's a dangerous shift, because the market doesn't reward conviction. It rewards clarity, and clarity requires space, mental space. The 2% rule creates that space. When your downside is limited, your mind doesn't feel threatened. And when your mind doesn't feel threatened, it doesn't need to react impulsively. You can let the trade play out. You can follow your plan without interference. Let me ask you, how often do you actually let your trades reach their intended outcome? Not where you feel like exiting, but where your plan says to exit. If the answer is not often, then the issue isn't your strategy, it's your ability to stay consistent under pressure. And pressure comes from risk. So instead of trying to fix your strategy, you reduce the pressure. That's what the 2% rule does. It standardizes your exposure so your mind doesn't fluctuate between extremes. You're not overly cautious after a loss. You're not overly confident after a win. You stay centered. And that centered state is where good decisions happen. Now consider this. If your thinking stays stable, your behavior stays stable. And if your behavior stays stable, your results begin to reflect your actual edge, not your emotional reactions. But without that stability, even a strong edge gets distorted. You might have a strategy that works over 100 trades, but if your behavior changes every 5 trades, you never give it the chance to play out. So the real question is, are you giving your system a fair environment to perform? Or are you constantly disrupting it with inconsistent risk and emotional decisions? Because the market isn't just testing your strategy, it's testing your ability to remain unchanged while outcomes vary. And that's not easy, but it becomes easier when the stakes are controlled. When no single trade has the power to disturb your thinking, you stop reacting to individual outcomes. You start thinking in sequences. You begin to see patterns over time instead of obsessing over moments. That's when your perspective shifts. You're no longer focused on being right. You're focused on executing well. And execution is a mental skill. It depends on clarity, patience, and emotional control, none of which can exist when your risk is too high. So the 2% rule isn't just a number. It's a boundary that protects your ability to think clearly under uncertainty. Most traders don't blow accounts in one trade. They do it by abandoning limits. It rarely happens the way people imagine. There's no single dramatic moment, no obvious turning point where everything collapses at once. Instead, it's quieter than that. A series of small decisions, each one slightly outside the rules, each one justified in the moment. Let me ask you, have you ever told yourself, just this once? Just this once, you'll risk a little more. Just this once, you'll move the stop. Just this once, you'll hold on a bit longer because the setup still looks good. It never feels like a breaking point when it happens. It feels reasonable. That's how limits get abandoned. Not suddenly, but gradually. The first time you exceed your risk, it might even work out. You take a larger position, the trade goes your way, and now you're rewarded for breaking your rule. That's where the real damage begins. Not in the loss, but in the success that came from ignoring discipline. Because now your mind has a new reference point. You start to believe that the rules are flexible, that they can be adjusted depending on how confident you feel. And confidence, in trading, is often just recent memory disguised as certainty. Have you noticed how confidence increases after a few wins? You feel sharper, more in sync. You start trusting your instincts more than your structure. And slowly, almost without realizing it, you begin to drift. Position sizes get slightly larger. Entries become less precise. Risk becomes something you manage emotionally instead of mechanically. Nothing seems wrong at first, until the market shifts. And when it does, the same flexibility that helped you on the way up begins to work against you. Losses come, but now they're larger, more impactful. And because they're larger, they trigger a stronger reaction. You want to recover. So what do? You take another trade, maybe not the best one, but it's there. You increase size again, trying to make back what you lost. And now you're no longer trading your plan. You're trading your situation. That's the cycle. It doesn't take one trade to damage an account. It takes a series of undisciplined responses to loss, each one slightly worse than the last, each one driven by the same thought. I can fix this. But the market doesn't reward urgency, it punishes it. So instead of recovering, the situation compounds, losses stack, pressure builds, and with pressure comes more mistakes. Not because you lack knowledge, but because your decisions are no longer grounded. Let me ask you, how often do traders actually return to their rules after breaking them? Not immediately. Usually, it takes a significant drawdown. Enough pain to force reflection, but by then, the damage is already done. And when they do return to their rules, something has changed. Confidence is lower. Hesitation is higher. The same setups that once felt clear now feel uncertain. Not because the market changed, but because their trust in their own process has been weakened. This is the hidden cost of abandoning limits. It's not just financial, it's psychological. Because once you prove to yourself that you're willing to break your own rules, you lose a level of internal stability. You can't fully rely on your decisions anymore. There's always that question in the background. Will I stick to my plan this time? And that doubt affects execution. Now consider the alternative. A trader who never abandons limits. They take losses, yes. They experience drawdowns, of course. But their behavior remains consistent. Risk stays controlled. Position size doesn't fluctuate based on emotion. And because of that, no single moment spirals out of control. Their account doesn't collapse. It fluctuates within boundaries. That's the difference. Not intelligence. Not strategy. Just adherence to limits. Have you ever looked at a blown account and tried to trace it back? It's rarely one trade. It's a pattern. A pattern of increasing risk after losses. A pattern of bending rules under pressure. A pattern of believing that one good trade can fix everything. But trading doesn't work that way. There's no reset button. No shortcut back to even. Every decision carries forward. Every mistake compounds if left unchecked. So the real danger isn't losing money. It's losing structure. Because once structure is gone, you're no longer operating within a system. You're improvising. And improvisation, under pressure, leads to inconsistency. And inconsistency is what eventually leads to collapse. Consistency in risk creates consistency in behavior, not just results. Most traders focus on outcomes. They track wins, losses, profit percentages. They judge themselves based on what the market gives back. But let me ask you, what happens to your behavior when those results start to fluctuate? After a win, you feel confident. After a loss, you feel cautious. After a streak, you feel either invincible or uncertain. And without realizing it, your decisions begin to shift with those emotions. So the real question is, are you trading your strategy, or are you trading your last result? Because if your behavior changes based on outcomes, then your system is never being executed the same way twice. That's where consistent risk becomes critical. When you risk the same percentage on every trade, you remove one of the biggest variables in your decision making. You're no longer adjusting exposure based on how you feel. You're not increasing size after a win or shrinking it out of fear after a loss. You stay steady, and that steadiness does something important. It stabilizes your behavior. Think about what usually causes inconsistency. It's not lack of knowledge. It's emotional swings, confidence rising and falling, fear creeping in when losses occur, overconfidence appearing when things go well. Now ask yourself, what amplifies those emotional swings? Risk. The more you put on the line, the more intense your reactions become. And when reactions intensify, behavior becomes less predictable. But when risk is controlled and consistent, those emotional spikes are reduced. You don't feel dramatically different from one trade to the next. And because you don't feel different, you don't act differently. That's the connection most traders miss. They try to fix behavior directly, telling themselves to be more disciplined, more patient, more focused. But behavior isn't something you force. It's something that emerges from the conditions you operate in. Change the conditions, and behavior follows. Consistent risk is one of those conditions. Let me ask you, have you ever taken the exact same setup twice, but managed it completely differently? One time you let it run. The other time you exited early. Not because the setup changed, but because you felt different. Maybe the first time you were calm. The second time you were recovering from a loss, or protecting recent gains. That difference in feeling leads to a difference in action. And that difference in action leads to inconsistent results. So instead of trying to control every decision manually, you standardize the environment in which those decisions are made. That's what consistent risk does. It creates a baseline. Every trade carries the same weight. Every outcome has a similar impact. Nothing feels disproportionately important. And because nothing feels exaggerated, your responses stay balanced. You're not reacting, you're executing. Now consider what happens over time. If your behavior is consistent, then your strategy is being applied consistently. And if your strategy has any edge at all, it needs that consistency to show up in your results. Without it, you never get a clear picture. You might have a profitable system, but if your behavior keeps changing, the results become distorted. Wins are cut short. Losses are extended. Good setups are skipped. Poor ones are taken out of frustration. And then you're left wondering why nothing works. But the issue isn't the system. It's the inconsistency in how it's being executed. So let me ask you, How can you expect consistent results from inconsistent behavior? You can't. And how do you create consistent behavior? You remove unnecessary variables. Risk is one of the biggest. When risk fluctuates, everything else starts to fluctuate with it. Your emotions, your expectations, your tolerance for movement, your willingness to follow rules. But when risk is fixed, those fluctuations are minimized. You begin to operate in a narrower range of emotion, not overly excited, not overly stressed, just focused. And in that state, decision-making improves. You see setups more clearly. You manage trades more objectively. You're less influenced by what just happened and more aligned with what's actually in front of you. That's where real consistency comes from. You don't need to win more, you need to lose properly. That idea feels wrong at first. Everything about trading seems to point in the opposite direction. More wins should mean more profit. Fewer losses should mean better performance. But let me ask you, have you ever had a high win rate and still ended up with little to show for it? It happens more often than people admit. Because winning more doesn't automatically mean you're trading well. It often just means you're avoiding losses, cutting trades too early, taking quick profits, refusing to accept when you're wrong. And while that feels good in the moment, it creates a hidden imbalance. You collect small wins and then give them back in one uncontrolled loss. So the issue isn't how often you win. It's how you handle being wrong. What does it actually mean to lose properly? It means the loss was planned before the trade began. The risk was defined. The stop level made sense. And when price reached that level, you exited without hesitation. No negotiation, no adjustment, no second guessing. Now ask yourself, how often do you actually do that? Because most traders don't struggle with entries, they struggle with exits. Not the profitable ones, the losing ones. That's where discipline breaks. A proper loss is small, contained, and expected. It doesn't surprise you, because you already accepted it before entering. But an improper loss grows. It stretches beyond its original boundary. And as it grows, so does your emotional involvement. You start hoping instead of deciding. And hope has no place in execution. Have you ever watched a losing trade move further against you, knowing you should exit, but waiting anyway? That moment is where most of the damage happens. Not because the market moved, but because you didn't act. Losing properly removes that moment entirely. The decision is already made. You're not reacting. You're following through. And that follow-through is what builds consistency. Now consider the opposite. If you focus only on winning, your attention shifts toward being right. You want confirmation. You want the market to agree with you. And when it doesn't, you resist. You delay the exit because closing the trade means admitting you were wrong. But trading isn't about being right. It's about managing outcomes. And outcomes include losses. So instead of trying to eliminate them, you learn to handle them correctly. Let me ask you, what would happen if every loss you took was small and controlled? No large drawdowns, no emotional reactions, no need to recover, just a series of manageable outcomes. Would you still feel the same pressure to win? Probably not, because the urgency comes from imbalance. It comes from knowing that one mistake can undo multiple correct decisions. But when losses are controlled, that imbalance disappears. You're no longer trying to compensate for anything. You're just executing. That's where the shift happens. You stop measuring success by how many trades you win and start measuring it by how well you follow your rules, especially when you're wrong. Because anyone can follow a plan when they're winning. The real test is what happens when the market moves against you. Do you exit cleanly? Or do you hesitate? Do you accept the loss? Or do you try to avoid it? Those decisions define your performance far more than your entries ever will. Now think about this. If you lose properly, you stay in control. If you stay in control, your behavior remains consistent. And if your behavior remains consistent, your strategy has a chance to work over time. But if losses are mishandled, everything breaks. Your confidence drops. Your decisions become reactive. You start deviating, and once deviation begins, results become unpredictable. So the goal isn't to avoid losing. It's to lose in a way that doesn't disrupt you. A way that keeps your process intact. a way that allows you to take the next trade with the same clarity as the last. Have you ever taken a loss and immediately felt the need to do something, anything, to make it back? That impulse comes from improper loss, because the loss wasn't just financial, it was emotional, and emotional losses demand action. Proper losses don't. They end where they're supposed to end. They don't carry over. They don't influence what comes next. They're contained. And containment is what allows continuity. Position size should adapt to risk, not the other way around.